Barron's says the debt ceiling fight is already costing the economy. Let's take a look. Here we go again. The Republicans in Congress and Biden administration are deadlocked over the possibility of raising the current ceiling on the U.S. government debt. And let me just spoil the surprise. They're going to raise it. You could see all the hype in the media and what they're doing. But look, there's no doubt the government's been overspending, whether it's Republican or Democrats, for decades now. Exponential spending. And it's led to $31.5 trillion of debt. It currently appears that the X date, the date where the U.S. Treasury will not be able to pay all of its bills on time and will consequently default on the obligations of the federal government, will be as soon as June 1st. Now, by the way, Treasuries are normally known as the least risk investment someone could make because it's backed by the full power of the U.S. government's taxing ability. And yet it's a lot of news saying you should definitely put your money there, but they're also saying that there could be this default. Janet Yellen's talking about it. It feels like two parties fighting against each other, but ultimately, just like when we saw in Obama's administration, and they said they wouldn't increase the debt ceiling, they absolutely did. I think the same thing's going to happen here. It is widely understood that the consequences of a default would be hugely negative for the U.S. economy. You know what's also hugely negative for the U.S. economy? Overspending. Bailing out the banks in 2008 and 2009 because of what's supposed to be regulation that didn't actually protect anyone. And, it's a pretty broken system here. What's less well recognized is that the uncertainty over the past few months as to what could happen already inflicted some costs. Even if a compromise is reached and disaster averted, the longer-run consequences for the federal government and the U.S. economy more generally are still likely to be adverse. Enter the credit rating agencies. Moody's, S&P Global, and Fitch are three major credit rating agencies in the U.S. There are others, but these are the big three. They play a major role in modern financial markets. They issue ratings such as AA, BB, etc. on the bonds that are issued by companies and governments. That's why they're often described as bond rating agencies. Now, if you ever watched the brilliant movie called The Big Short, they walk into one of these rating agencies. They're like, why are you giving these collateralized debt obligations, which were these defunct mortgages that were rated AAA? And they're saying, yeah, they're fine, but there weren't. They went and knocked on doors, found out a lot of these homes were vacant. People hadn't been making their payments. And yet they're like, well, if we don't give them good ratings, they'll just go get them somewhere else. So these aren't always the best indicator because there's these pressures of profitability that don't always allow them to be kind of transparent. So it says as a practical matter, these ratings present the rating agency's options to the creditworthiness of the bonds of the bond's issuers. In essence, the bond raters' opinions as to the likelihood that the bonds raters' opinions as to the likelihood that the bondholders will receive the interest and paid back principal in a timely fashion, right? They're saying, what are the chances? At least some bond investors, the bond market's largely an institutional market, appear to pay attention to these ratings. And what they mean by institutional market, you got big insurance companies buying them, you got big corporations, you got big banks, things like that. And when I say big corporations, I'm talking about Wall Street. Although the credit rating agencies' ratings of corporate bonds and municipal bonds often attract more media attention, the agencies also rate U.S. government bonds. Until 2011, all three rating agencies had the U.S. debt as a AAA, the highest possible rating. In S&P's language, the capacity to meet its financial commitments on the obligation is extremely strong. And therein lies an important tell. In the summer of 2011, the Obama administration came close to the cliff. This is what I mentioned a little bit earlier. In its negotiation with Republicans in Congress over raising the debt ceiling. But of course, they raised it, right? A compromise was reached in early August and a default was avoided, right? But a few days after the compromise was reached, S&P downgraded all U.S. bonds to an AA+ instead of an AAA. For S&P, an obligation rated AA differs from the highest rated obligations only to a small degree. The issuer's capacity to meet its financial commitments on the obligation is very strong. And the plus makes the difference even smaller. Still, there's a difference between extremely and very, and S&P's ratings had remained AA+ to this day. Why does this matter? Because the Treasury's cost of borrowing may well have increased a little bit. Yeah. I mean, look at how much interest, like when we have $31.5 trillion of debt, not a big deal at 1%, 2% interest. 4.5% at 5%, that's an extraordinary amount of interest for that amount of money. So in higher borrowing costs of even 1 or 2 basis points, a basis point is 1/100th of a percentage point, can mount up to when the publicly held amount of the national debt, this says is around 25 trillion, but what I'm seeing is 31.5, and the Treasury's borrowing, refinancing existing debt plus new debt around 3 trillion annually. In a similar vein to the U.S. Government Accountability Office in 2012, estimated that the uncertainty prior to the early August agreement and the S&P 500's downgrade cost the Treasury $1.3 billion in higher borrowing costs. So now people are like, I don't know if I trust it. And so they have to offer better interest rates, essentially, to attract borrowers. So that leads us to kind of what's going on right now, right? And so, but even if the Biden administration and the congressional Republicans reach an agreement before June 1st, unless the agreement includes the abolition of the wholesaling concept, which seems unlikely in the current political climate, this game of chicken is likely to reoccur every few years. And one of these times, right, these two sides may not reach an agreement before the cliff. Well, I don't know if I really agree with that because we know it's political suicide. We know it's flexing. We know it's like, oh, but then it's like, okay, so we're just going to default. And then what happens, because people won't lend you money, is I guess they just create new policies and they find ways to get the money somewhere else, right? Consider what will happen even if an agreement's reached before June 1st. If you're responsible for, say, Moody's or Fitch's ratings of U.S. debt, would you in good conscience feel comfortable concluding the probability that U.S. will continue to meet its obligation in a timely manner was extremely strong? Accordingly, more rating agency downgrades of U.S. debt may well be already baked in. And with that will come higher borrowing costs, which is already higher because of the interest rate increase of the Fed, right? And this weakening of the U.S. dollar's position as the world's premier reserve currency for international transactions, which we're hearing a lot of news, right, about Brazil and China. When these downgrades happen, there will be a loud cry in Washington to blame the rating agencies for their baseless downgrades that will increase taxpayers' costs. In essence, the cry will be shoot the messenger. But think about the possibility when we watch this game of chicken being played again and again, and when we watch that the government is borrowing so much money, and even if they tax us at 100%, could we pay back $31.5 trillion? So these are just a few things to consider. You know, a lot of people go, oh, treasuries, I'll just put my money there. Banks, I'll just put my money there. But we watched 3 banks go under and cost us $36 billion in FDIC. And we saw in 2009 when a ton of banks went under, it was trillions of dollars of cost. It tapped out the FDIC so early and ended up being a burden on the taxpayers. So what are you going to do instead? Invest in yourself, plug your financial leaks, figure out how you can increase your earnings, start to acquire assets that create cash flow, invest in alignment with things you know and understand and that are hard assets, or maybe it's intellectual property, maybe it's real property, or maybe even start learning a little bit about Bitcoin here and there. But ultimately, it's not about speculating on this. It's not about going, oh, I just trust the government or I just trust the banks. I use cash value, cash flow banking as my cash basis, which doesn't fractionalize banking like you see in the banks, which means that they have actual dollars backing the dollars that are in their accounts. They handled 2009 really well with mutual insurance companies, which banks didn't handle as well. So these ideas are out there, and you can check out these options. You know what? If you go to GarrettGunderson.com/WWBD, as in what would billionaires do, you'll start to see how you can prevent the loss of your principal if interest rates continue to change, where you're not subject to bank failures being a problem for your money, and you can get into something other than FDIC, which protects your bank deposits that have never been tapped into with guarantee associations on these cash value policies. So cash value, so you have cash that doesn't participate in the market downturns, investing in yourself so you can build more skill sets to serve others, solve problems, and add value. Pay yourself first, so you take money automatically off the top and build up your liquidity. And then when you have enough cash, you can deliberately invest when the right opportunities come, and there's going to be so many opportunities, and not just set your money into a bank or into treasuries and just hope for the best, because we see there are some problems. We see there are some concerns here, but I'm here to help you get solutions. So I have plenty of other videos like this where you can start to learn what's in the articles, if they're asking the right questions, if there's more to the story than what's being told, and also to heed warning when they're absolutely right. So let's go ahead and be the watchdog, the sheepdog, and figure out how you can keep more of your cash, have less worry and stress in your mind, and live a life filled with prosperity. Hey, thanks for watching. I appreciate it. And if you're enjoying these videos, well, there's good news. More where that came from, so go ahead and click through and watch the next video now.